Hey there, everybody. Thomas with the Basecamp Trading. It is Thursday, January 24th, and we're going to take a look really quick at one of the trades from the futures trading room earlier today, and that was a compression breakout in the Dow. Played out really well, and the reason I want to talk about this is not to beat a dead horse and show you yet another well-defined support resistance break, because I've done a lot of videos on that in the past, but I want to show you and talk on the importance of having something like the value charts or value bars indicator to tell you when a market has gotten extended. So the way value bars work, that's what's on this price chart here, painting the price bar different colors. We have significantly overvalued and significantly undervalued, which are the upper and lower red price bar segments, moderately over and undervalued, which are the upper and lower yellow price bar segments, and then fair value in the center green area. And this is one of our patented tools. We've had it back tested over 30 plus years of data from PhD statisticians from Wharton, UCLA, and others, and they've all agreed, yes, it statistically shows you when markets have a higher probability of reversing or being too extended, so being over or undervalued relative to recent price movement. And the reason I tell you this is because this is how we use it. We had the breakdown this morning in the Dow, and you can see we sold here, added here, and then we covered the whole position right down here right before the full-blown reversal back up to the upside. And the reason that's important is because the way we timed that was using value bars. As soon as we hit significantly undervalued here, it's saying, hey, this run is extended, it's due for a correction, a retracement. Doesn't mean that the move's necessarily over, just means, hey, it doesn't typically trade there. Historically speaking, we only trade significantly over or undervalued about 2 to 2.5% of the time. So very rarely do we stay in that red section. And if we do, normally very quickly afterwards, we're going to retrace or bounce or reverse. So that's why we're taking profits there and looking for the bounce, and ended up just climbing straight back up from there. But if you look in the past, you can see just the past couple of days here, you have significantly undervalued and we trace back up, significantly undervalued, then we trace back up. And again, it's not saying that the move is over. It's just saying that that price bar interval too extended, it needs to pull back a bit. And you can see earlier when it significantly overvalued yesterday, then reversed, overvalued, consolidated sideways before climbing again, undervalued, reversed, overvalued, reversed, undervalued, bounce, undervalued, bounced. Okay, so my point here is make sure you have a tool, something like the value charts or the value bars indicators, which you can get at Basecamp Trading, and use those for determining when markets are too extended, so that you do not end up jumping in on an extended market only to have it reverse right after you get in it. Okay, it's also a great tool to use for profit taking. So that is it for today, though. I hope it helps. I'll see you in the trading room bright and early tomorrow morning. Don't forget, like and subscribe if you're enjoying these videos. We're trying to give you free education and help you become a better trader. So don't forget to check us out in the trading room tomorrow. There's a link in the description below if you want to try us out for an entire month. And I'm excited to say we have Gary Edwards coming on, joining the Basecamp Trading team. He'll be running a trading room session for futures during the London session, so during European trading hours between 3 a.m. Eastern and 8 a.m. Eastern, and then I'll take over from there from 8 to noon every day. So that's coming in a couple of weeks starting here in February. But that is it for today. I'll see you in the next one, and until next time, everybody, happy trading.